Good morning and welcome to your Tuesday, 27th of February market news update. Steel, iron ore and copper prices fall as persistently weak demand in China causes inventory pile-ups. The Japanese yen remains subdued near the 150 level despite the nationwide core CPI rate slowing less than expected. eBay steps forth to deliver its earnings report in the aftermarket hours. Euro continues its ascent from its recent two-week trough, and the market braces for inflation updates later this week. Consumer morale in Germany records slight improvement, albeit the depressing economic conditions. US stock markets ended yesterday's session with marginal losses as traders brace for an upside PCE surprise. Finally, the FAA deems Boeing's actions to improve plane quality as insufficient. That's all for now, and stay tuned for tomorrow's market update.
Hi, everybody, and welcome to another daily presentation. This is the market overview for the 27th of February of 2024, and these are the key events that you should familiarize yourself before starting your trading day. Now, the first and sole topic of the day is going to be about RBNZ's interest rate decision. So, in tomorrow's early Asian session, Kiwi traders will tune in for the Reserve Bank of New Zealand's monetary policy decision, the first one for 2024, which has direct implications for the trajectory of the antipodian currency. Now, the New Zealand dollar, the Kiwi, has fallen victim to the dollar's dominancy since the start of the year. However, after forming a trough above the 0.60 level against the dollar, it has managed to rebound and hit 5-week highs as we saw the greenback starting to show some sort of signs of weakness. Now, in regards to the decision in and of itself, the market foresees that the central bank will extend the pause of its tightening campaign for the fifth consecutive session and keep the official cash rate, the OCR, unchanged at the 5.5% level near 15-year highs, despite the CPI, the inflationary pressures, hovering more than 2 times higher than the bank's 1.1 to 3% target. Now, headline inflation in New Zealand was reported at 4.7% in the fourth quarter of 2023, easing further from the 7.3% peak recorded in the second half of 2022, relieving some stress off RBNZ's policymakers' shoulders, yet sticky household and utilities, rent, and food inflation remain indeed stubborn, and they are many times higher and above the target of the central bank, which at the end of the day continue to impose severe problems for the everyday New Zealanders. Okay, so RBNZ policymakers stated that the OCR, the overnight cash rate, the official cash rate more specifically, needs to stay at restricted levels for longer to return inflation back towards the target. Yet the effects of the bank's cumulative tightening have given rise to substantial spending restrictions. This is the problem of keeping the current monetary policy practices at these kind of levels. And the capping of the nation's growth trajectory is also one other problem. But it may have contributed to the undesirable sequential upside of unemployment and the impediment of the nation's job creating mechanism. So policymakers understand that the current restricted level of interest rates are hurting or impacting growth, the nation's job market, the labor market, but also the consumption trends of New Zealanders. But at the end of the day, they see that their job is to bring inflationary pressures back towards the target. And if we continue to see, according to them, inflationary pressures remaining well above the 1 to 3% target, they don't have any other given choice rather than to pause for another session, their monetary policy campaign, or at the end of the day, even consider hiking rates even further to make sure that inflationary pressures are moving towards the level, the desirable level at and in a timely manner, if you will like. Excuse me. So currently, Kiwi OYS probability is assigned a 77% chance in the pause scenario. However, they also foresee the prolongment of the currency of the current policy agenda up until November, where we see probabilities or the scenarios for a 25 points rate cut by RBNZ being currently being priced in. We have to note, nonetheless, that the prospect for a 25 basis point hike is also on the table in for tomorrow's meeting, albeit amassing a 23% chance. And if we remember what has happened at the last meeting, the penultimate meeting of RBNZ was in December of 2023. At that point in time, we saw RBNZ policymakers noting that they have a terminal rate for 2024 at 5.7%, okay, indicating that they're willing, in a sense, to hike rates even further because currently we have them at 5.5%. So another 25 basis points was hinted by policymakers. And at that point in time, after the decision, we saw NZDOI's probabilities amassing an 85% chance for a hike scenario in today's meeting, in tomorrow's meeting more specifically. And we have seen these probabilities going the other way. Okay, so from 85% chance for a hike scenario back in December, we are currently standing at a 23% chance for a hike in this meeting. So we see this movement away, or at least this pivoting away, or this divergence from market participants' point of view and RBNZ's point of view. Okay, the bank says they're willing to push rates even further, whereas money markets see them keeping rates steady, and after a period of time, they see them cutting rates. Okay, so the fact that the fact that money markets even consider this kind of scenario at the time where almost all other major central banks ferociously bang the rate cut drum says a lot about the severity of the situation in New Zealand, and we will not be surprised to see RBNZ pushing rates by 25 basis points higher in tomorrow's session, albeit this small percentage. Okay, and if this comes into fruition, the hike scenario, we would expect the Kiwi to strengthen considerably. Okay, so for the time being, the status quo kind of scenario is for a pause. We won't expect to see any sort of a cut by RBNZ. So if we get a pause and some hawkish messages from RBNZ, we expect the Kiwi to gain some sort of support and strength. If on the flip side, then this is an outrageous kind of scenario, outrageous kind of call. If we see them hiking by 25 basis point, we would reasonably expect to see the Kiwi strengthening considerably. Okay, so for the time being, we have to leave it at that. Thanks for watching, guys. We'll catch you on to tomorrow's session to give you a brief update on what has happened with RBNZ's decision. For the time being, this has been the end of today's session, guys. Thanks for watching, and we'll catch you on to tomorrow's session for another brief update. Take care. Bye-bye.
everyone. In this video, we're going to talk about the scalping strategy. Scalping is a forex trading strategy that involves opening and closing multiple positions on one or more financial instruments over the course of a day, usually in seconds or minutes. Instead of opening one position at the start of a trend and closing it at the end, scalpers will open and close several positions over the course of a trend. Scalpers usually hold a position for a relatively short period of time, entering and exiting a trade within minutes, if not seconds. The aim of scalping is to gain just a few pips at a time, seeking several little gains rather than fewer larger ones. Scalpers frequently use CFDs to trade forex pairs that are rising or falling in value. They will open a position to buy if they believe the price will rise and open a position to sell if they think that the price will fall. Because of the short time between transactions and the rapidity with which the scalper works with price differentials, traders are exposed to less risk overall. Furthermore, if the trader is very disciplined about cutting losses on losing transactions, the risk is reduced even further. CFDs, which are leveraged products, also enable traders to open a position with a deposit called a margin. Leverage can magnify profits, but can just as easily magnify losses, so it's a double-edged sword. That's why it's so important to have an appropriate risk management strategy in place, no matter which trading technique you're using. Basically, for a scalper to make a significant amount of profit, a larger position size is usually required to make the trade worthwhile. But scalpers must be very careful to avoid high volatility when trading in the forex market and to have a reliable broker with good execution pricing. Thank you for watching, and in our next video, we will talk about a different trading strategy.
So today we're gonna continue with our series. We're almost there. If I'm not mistaken, we have another episode or another webinar to this series. Hopefully we're gonna add a few more in January. If not, we're gonna go ahead and start all over again. Okay, so these are the few final sessions we will have, and you will see how how far we've come so far and how everything we've learned so far, we're gonna put them all together in a live practice session. If I'm not mistaken, the next session we will probably do that to see what we've learned so far, how you can apply them directly, and we're going to do this together in a live environment to see if everything makes sense, if you're going to get what we call a lovely entry and exit points where you can actually trade and capitalize upon. So that will be much more interactive and much more nicer. That's because we've covered a lot of stuff in the past, and we're going to go past the theory and we're going to go into practice, which is essentially what we care about. Okay. So in today's webinar, give me one sec. In today's webinar, we will go over Fibonacci extensions much more specifically. We could have had introduced the concept when we've done the Fibonacci retracement, since they fall under the same category. They are pretty much the same. They have a few different tweaks, but the rationale behind Fibonacci is pretty much the same. Either it's going to be Fibonacci retracement, extensions, expansions, and all that kind of stuff, retracements. The point here is, once again, to keep in the back of your mind that we use, and hopefully we're going to use them correctly. Fibonacci, the Fibonacci tools in general, the prime reason why you use Fibonacci retracement, Fibonacci expansion, and all that kind of stuff is to find entry and exit points. And the sole reason is just for that. Essentially, identify key levels where we expect to see price action, finding support from, or heading towards to a possible resistance level that we're going to see a failure of a breakout. Okay, so the prime reason why we use Fibonacci is to identify levels either acting as support and resistance levels, and if we do that and establish support and resistance levels, from there on we can use those kind of levels if they actually have some sort of validity as entry or exit points. Okay, they do not predict the future. They do not give you an indication where the market is going to move towards to next. They are simply, they're mere tools of identifying key levels where you could reasonably expect to see the price action stalling from, okay, at much more accurate. Okay, so Fibonacci extensions. Let's begin with a small, the bloody risk warning and disclaimer. Bear with me. I'm going to give it a go and finish this under a minute. Okay, so our risk warning is our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and that you should ensure that you understand all the risks involved. Disclaimer is, the information in this webinar shall not be considered as investment advice or investment recommendation, but instead is for educational purposes only. This material is just a personal opinion of the author, and the client investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and the redistribution of the material is strictly prohibited. Okay, out of the way, moving on. So, Fibonacci extensions, they fall under the bracket of mechanical analysis, and much more if we dive a little bit more deeper and we just fork the whole thing down. Okay, we have on chart and off chart indicators. We mentioned this a million times by now. So the Fibonacci tools in general, okay, either extension, retracement, expansion, and all this kind of stuff, they fall under what, in my analysis or in my estimates anyways, on my way of categorizing things, under the branch of on-chart indicators, mainly because they go onto the chart. Okay, so on-chart indicators we covered in the past: moving averages, Bollinger Bands, Ichimoku clouds. We have not, and parabolic SARs we have not. Pretty much the same thing with other ones, so they're not something wow still. We have covered in the past session Fibonacci retracement, and today we're going to do Fibonacci expansion or extension. Okay, so other types of technical indicators are what we call off-chart ones, which are what we call oscillators. They go below the chart, hence the term, hence the categorization off-chart. So we have relative strength index, MACD, ADX, and momentum, and many others. Okay, so this is a short list of the ones that I personally like to brand as useful, at least from my own experience. And this is what we're going to convey here. So Fibonacci extensions. Moving on, what are Fibonacci extensions? But before we go into that, let's do a small recap of how the Fibonacci sequence in general arises and how we came up with the Fibonacci key ratios and the tool Fibonacci extension. So Fibonacci sequence was invented by an Italian mathematician named Leonardo Bonacci, but that was back in the early 13th century. However, it's widely believed that this kind of sequence was invented or was stumbled upon in ancient India, and the concept of Fibonacci sequence in general was introduced to Mr. Leonardo Bonacci by some Indian merchants. Okay, so the origins of the sequence go back as far back as the 6th century BCE. Okay, so that's the earliest traces we have from the Fibonacci sequence. Irrespective is a small brief history lesson. Okay, something else to keep in the back of your mind. So Fibonacci sequence is also closely connected to what we call the golden ratio. Okay, so also known as the divine proportion, which can be found in many different things in the environment around us as human beings. For example, you can find this kind of key ratio, okay, in sunflowers, in galaxy formations, in shells, in historical artifacts, architecture, in people's faces, and all that kind of stuff, okay? So we have some sort of innate drive of unconsciously, knowing it or not, because unconsciously you don't know it still, of identifying these kind of key ratios. For some reason we're kind of primed as human beings to not calculate, but recognize this kind of symmetry and this kind of what we call harmonic, or this kind of divine proportion. And therefore that's how the whole Fibonacci theme or move was kind of created, because they at the early stages of 1980s, 1990s, some mathematicians dabbled with trading, and they said, you know what, we might find this kind of divine proportion in price action as well. Why not? We have seen it in many different other areas of life. Why not find it in trading as well? So therefore that's how they aforementioned tools, the Fibonacci extension, retracement, and all the others were created with that thing at the back of their minds, okay? That we will some sort of detect some sort of key significance using these kind of ratios in price action, in trading as well. That's how the whole thing came into fruition, okay? Again, relative, not relative kind of historical kind of lesson. Adds on to your knowledge bank, okay? So, excuse me. So, Fibonacci sequence, that's where the whole thing is formulated, is predicated upon. That's how it's created, okay? What is the Fibonacci sequence? So it's a sequence that starts with 0 and 1 as the prime components of this kind of sequence, this series of numbers. And in a sense, we have each subsequent number being the sum total of the prior two. Okay, the fancy way of saying you take the first one and you add it to the next one, and therefore you get a new number. So, for example, 0, and you start with 0 and 1 as we just mentioned, the prime components. Add 0 and 1, you get 1, 1, and 1. So the one before it, you get 2, 2 and 1, you get 3, 3 and 2, you get 5, 5 and 3, you get 8, 8 and 5, you get 13, 13 and 8, you get 21. And this kind of sequence, if you continue doing the same thing, so add the number that you have in front of you with the one that precedes it, so the prior one, you get a new number, and you keep continuing doing this. That is how the Fibonacci sequence is formulated upon, and it continues to go indefinitely, because there's no reason of explaining this. It's pretty self-explanatory by itself. Okay, now when it comes to trading, but practitioners commonly use this ratio and many other related ratios to establish where the price action may head towards to, or when the trend is indeed extended. So this is particularly the case for Fibonacci extension. Now the retracement is pretty much the same thing, but with a small modification. In regards to retracement, for example, you assume that the current trend, okay, not assume, but you point out due to higher highs and higher lows, that the current trajectory of the market of that specific instrument is moving to the upside. So you have an upward moving trend, okay, around that specific instrument. Once you identify that, you reasonably expect to see some sort of pullbacks, because there's a common theme in trading. Prices do not move in a linear fashion. For example, they don't upshot and keep continuing upwards. They do move in a much more like a zigzag kind of fashion. They go up and then they come down, they go up and they come down, but they have some sort of direction. Once you establish that direction, you would, in a sense, use it while you use this kind of tools. For example, the Fibonacci retracement tool, you see you are extrapolating when will the next pullback or the next retracement will take place, and therefore you would attempt to estimate where the specific retracement will stop, and when is the primary direction of the market will continue moving towards to. That's the reason why you use them. And particularly speaking for the Fibonacci extension tool, I personally like to use it in
when I'm studying a specific instrument, a specific asset, a specific share, for example, that is moving, it has a clear upward or downwards trajectory, and you do not have, prior past action that the current levels are going to move towards to. For example, what I mean by this is, for example, when you look at, I don't know, Apple's share price, you see that it has hit, or Microsoft share price currently has hit all-time highs. Therefore, you do not have an area that the price action has visited before when it comes to the upside. Therefore, you could use, in a sense, the Fibonacci extension tool in order to extrapolate where the price action is going to move towards to next in the future. Okay, once you have conditions of uncharted territory, that means the price action have not moved in that area ever in the past, and therefore you cannot draw conclusions from prior action. You use a viable way of using the Fibonacci extension tool is to, in a sense, estimate where it might go towards to in the future, because you don't have past price action. Okay, that's one way of using it. You have you can be applied to many different scenarios, but my personal bias is that I like to use it in that kind of case. And after we finish with this kind of theoretical aspect of the presentation, we're going to move to the live environment, and we're going to do just that with either Microsoft or Apple or whatever else is trending near that kind of is fulfilling that criteria I just mentioned of uncharted territory. Okay, so we mentioned in the past webinar that the Fibonacci retracement tool has some key levels, that we are calculated automatically when you use them on your chart by using that tool, which, if you remember, if you can recall, is the 23.6, the 38.2, the 50, the 61.8, and whatever else you have there. So those were the key ratios for the Fibonacci retracement. On the same token, you have the Fibonacci extension tool having its own kind of key ratios, which are the 1.272 or the 127.2% level, the 141.4% level, the key 161.8% level, the 261, the 200, and you have many, many others. Okay, so we will see them in live action. Okay, so don't worry about that. Again, remember, it is automatically calculated once you plot it onto your charts. Okay, so there is no need for you to calculate manually these kind of levels while you use this kind of tool on your platform, on whatever charting tool you have, your charting software you have. You're going to have them plotted on your chart. So do not worry about this. The point is to digest, or at least introduce first the concepts, the key levels, and then digest them. The 127.2, the 141.4, the 161.8, etc. So these are the key ones that we will be seeing shortly. Okay, so bear with me. Now, why do traders use the aforementioned tool? Okay, so Fibonacci expansions are used to identify and establish potential profit target levels, or estimate how far a price may travel after a pullback is finished. So, for example, let's add all of them together. You use the Fibonacci retracement, you see where the price action has found support and is rebounding from, and therefore you are in a sense confident that the price action will extend to the upside. Now what we care about is where can we see the price action moving towards to next, and that's why we use the Fibonacci extension tool to see, you know what, their pullback has been completed, where to next. Fibonacci extension can give you some sort of indication. And for example, making another case here, if and only if you have plotted correctly the Fibonacci retracement tool on an upward moving kind of instrument, you found the areas where it's currently rebounding from. For example, it has rebounded from the 61.8 and is moving upwards. you have entered a long position there. You saw that kind of specific level after a confluence of different indicators, a convergence of different indicators, told you, you know what, the pullback is at the earlier stages of reversing or finishing. Okay, so you rush and you enter the position, you go long. Okay, where are your targets in regards to exiting now? You don't know. You plot the Fibonacci extension on top of the Fibonacci retracement, and you see where, you know what, I'm confident at exiting the position near the 127.2 level, 141.4 level, whatever that might be. Okay, so you use them in conjunction. You can use them both together or individually by itself. Okay, you can go ahead and do that by yourself. Okay, depending on who you are as a trader and what you would like to get out of the whole thing. Okay, so again, let me finish this kind of lovely sentence after I just rambled for a few minutes. They are used, when we're talking about Fibonacci extensions, are used to map out how far the next price wave could move after a pullback. And notice the wave, which is in bold and underlined there. This is a hint that Fibonacci extensions could be used efficiently so with some principles, key principles of Elliott wave theory. Again, not yet there to go into Elliott wave theory. It could be complicated once for introduced at a group of people that are now just acclimating with trading. So hopefully we're going to do a webinar about this Elliott wave theory. It's going to take us a long time, but still. So in a sense, we're talking about waves. So again, simply put, you have, according to Elliott wave theory, you have the prime example, which is a 3-wave kind of move. So you have an upside, an upshot move, a pullback, a sharper and longer kind of upside, another pullback, and then the last wave, which is the third part, which is the final part where you, in a sense, completes the 5-move wave. Okay, this is the simplest way of explaining it. So after that 5 wave, there's something else happening. We're not going to go into that. But the point is, we are assuming in a sense that we are, for example, in the first wave. Okay, so a rapid price appreciation and a pullback. You can use the Fibonacci extension tool to see where the price action is going to form the next leg up or the next wave. Okay, how far the next wave will go. Okay, hopefully I didn't confuse you. Apologies if I have. I'm going to make it more clear as we progress. Okay, so Fibonacci expansions use 3 points: the start of the move, the peak of the move, and a retracement, what we call also, in other words, a pullback. Okay, so these are the key points that you will see when we plot them on your charts. Okay, so Fibonacci extensions can be used in any time frame, for any time frame, or any given market, whether that is going to be equities, it's going to be commodities, it's going to be FX, it's going to be whatever that might be. Okay, so you can use it anywhere. Okay, the principles stand the same for each and every instrument under study, something else to have in mind, and any given time frame and any given instrument. Okay, typically clusters of Fibonacci levels indicate a price area that will be significant for the instrument and also for traders in their decision making. Again, we use them to identify potential levels of interest. That's it. Don't confuse it. Do not go into the way of thinking that, you know what, oh, you know what, this is clearly giving me indications of where the market is going to move towards. No, does not have predictive abilities. Okay, digest this, please. Okay, it's going to be for your own good. Now, since extension levels can be drawn on different price waves over time, when multiple levels from these different waves converge at one point, that could be a very important area. Okay, so the concept I have introduced in this kind of sentence right now is what I've been preaching upon since the start of this series. We do not use this tool solely by themselves. Okay, even if you do plot 2 Fibonacci extensions on different stages of the move, it does not fall under the category of sophisticated trading. Okay, please use all the other stuff we just mentioned in order for you to have a high degree of probability of making money. Okay, for example, why not use RSI? Why not use MACD? Why not use trend lines? Why not use resistance and support levels? Simple stuff. Okay, moving averages in general. Why not use all Bollinger Bands? Use them all together and see what the indications are telling you. Assess the impact or what the signals that everything is telling you, okay, and make a much more informed decision, okay, compared to just plotting a Fibonacci extension or retracement tool. And you know what, you see, I'm going to enter here and exit here. Okay, fair enough. You can do that, but that is not the optimal way of doing it. And you can do it much more optimally if you add all this kind of stuff together, but also study your fundamentals. Okay, again, this is my own personal bias. Once again, I like to implement fundamentals into the picture as well, because they give you extra add-on stuff that you don't get by trading alone, by technicals alone. Okay, so enough. What is the difference between Fibonacci extensions and Fibonacci retracement? It's a valid question. What is the difference between the two? They have the same name. At least half of the name is the same. We have Fibonacci on both sides, Fibonacci extensions, Fibonacci retracement. What is the difference between the two? Okay, so while we have extensions showing where the price will go or could go, much more accurately, I have to fix this, where the price action could go, no will go, this is not for sure. Following a retracement, Fibonacci retracement levels indicate how deep may be the retracement. Okay, so in other words, Fibonacci retracements attempt to measure, okay, the pullbacks within a trend, okay, while Fibonacci extensions measure the impulse wave in the direction of the trend, where, in other words, where the price action could go into the future, okay? Keyword could, not will, could, or may, okay? So there's a degree of uncertainty there. We have to point this out forthrightly and uprightly. Okay, so this is a super simple example of using Fibonacci extensions. Okay, this is a snapshot. We're going to go in a live environment soon. Okay, bear with me. For this is what Aussie dollar 1 hour chart for, I don't know, this is a past example. The point here is for you to spot any given problems if you can. Okay, so there is some that are actually flashing right in front of your eyes. Okay, so before we go into that, let's explain what I have here, what I've drawn here. Okay, so you have, in a sense, what we call assuming that this is a new wave, which is not, mainly because it has come from a sideways price action. Okay, so this is what we extrapolate being as an impulse wave, the first wave, this is the second wave, and then you go up for the third wave. Oh, sorry, you didn't see my mouse. Okay, first wave. So this is the start, this is the end, this is currently at that point in time, that was the full extension, okay, the full retracement that was at that level. I don't know if I have it on a different slide. Yep, okay. Why not use this? Let's use this. Okay, so at this point in time, the price action was currently up there, as you can see. Okay, it has no move there. Price action starts from there. This is the bottom. This is the, this is the start. This is the finish. Okay, and this is the complete move of the Fibonacci extension. Okay, so 0, 100, and we see this being the complete reversal of this kind of move. Now, we have also on top of that added the Fibonacci retracement. So start, finish of the move, and we see if it comes back down here, okay, which is the complete reversal, okay, the complete pullback back to where it started, okay. This is where it has peaked. Where are we could reasonably expect to see price action stalling and extending towards the upside, okay, assuming this is a primary move, okay, where it will start forming a bottom and then rebounding from extending into higher ground. Okay, so notice here the Fibonacci extension tools, extension levels, 127.2, the 141.2, and the 161.8, the ones I like to deem as key. Okay, this is my target area. But before we go into the target area, which the target area being the exit areas after a trade. Let's find essentially first the entry point, because we have not specified that. So currently, at that point in time, not currently, so we saw the price action moving to high ground, forming a top up there, and then retracing. We use the Fibonacci retracement tool to see how far the pullback will go towards to. We see it finding some stalling somewhere near the 23.6, broken definitively. Not the point in time where I expect to see the rebound taking place. We see sharp fall towards the 38.2, some sort of challenging here, but it faded away. The bears were actually in control and pushed the price action to lower ground. We see much nicer consolidation, okay, or fighting, if you will, like between bulls and bears near the 50 level. Also failed. And then the last resort, the 61.8, is the one that we see there, or at least that's where we start paying significant attention to, expecting that to see whether, you know what, this is going to be the final area of where we're going to see strong support, or if the bears will be much, much stronger and demolish this kind of level as well and finish the complete reversal of the move. At this point in time, he has found support once and bounced twice. Nothing serious, nothing, no big green candles indicating, you know what, this is surely the rebound ground. Okay, but hopefully I have the continuation of the price action. Nope. Okay, so after that, if I remember correctly, we saw a nice green candle after this. Okay, irrespective of that, still, if you saw, for example, a big green candle indicating that the bulls have actually entered the picture, okay, and driving the price action to high ground, you have an entry point, okay, somewhere near the 38.2 level after the complete breach of this kind of range, okay, either 50 or 38.2. And you have, for example, assuming, making a scenario here, you have entered the position somewhere in here. For example, you saw, assume this is green, okay, this is my entry point. So this is the, again, crude way of going at things where you're using only Fibonacci retracement and extensions, okay. Enter here. Where would my target level be? One might be this. If you're not that patient, fair enough. Or you're patient, or you're paying attention and you want to bank more money, okay. So the next areas of interest, because this is an uncharted territory, okay, it's a short time frame, I understand. The next target areas will be this, and this. And this is where we start paying much more significant attention to see, you know what, is the price action has moved up there, and you see this, okay, that's an area that I would be paying significant attention to. If you see a rebound, for example, at this kind of level, and the reapproachment of this level, you have much more confidence that the price action could go onto high ground. However, you are wait for the complete confirmation that this is not a double top, okay? And you want to see the third challenge breaking definitively above this, okay? Therefore, at that point in time, you would have said, this is my target area, or this is my target area, okay? So you take this with a grain of salt, okay? And you assess the situation as you progress through time. For example, you could have had take a profit certainly set up in place up there. No matter what happens, that's my target. Fair enough. Okay, or up there. So something else to remember is that the further, this is pretty self-explanatory once again, the further away you will go from your entry point and you set or take profit, obviously it's going to be much harder, relatively speaking, at being achieved. Much closer is much more easier, quote unquote. Okay, so these do not need explanations. You understand the point. So in a sense, we used here two things: Fibonacci retracements, tap, and Fibonacci extensions on top of that. Okay, Fibonacci retracements for entry. Disgusting handwriting. Fibonacci retracements for entry points and Fibonacci extensions for exit points. Okay, that's a crude way of doing or of using and applying on your charts Fibonacci retracement and extensions. Okay, hopefully that is easy to comprehend. Okay, remember, we use these as levels of where we would reasonably expect to see price action stalling at or passing through or failing to pass through. Okay, that is why we use the Fibonacci retracement and extension levels. They do not have price predicting abilities. Okay, so this kind of level, you have different indicators on top of your chart. Okay, much nicer. You have different stuff saying, where is the pointer? Okay, trying to describe the picture. At this kind of level, you see RSI being subdued between the 30 and the 50 level. So definitely bearish kind of territory, but you see some sort of consolidation taking place there. No drops below it. Okay, so this is the mix and match kind of indication. It's super vague. Okay, so for example, in our scenario that we expect to see the rebound of the price action, we would have needed or required to see definitive break above the 50 level. So you would have needed to see this for a confirmation. Okay, possibly venturing towards the 70 level. You would have also reasonably expected to see the price action moving closer to the upper bound of the Bollinger Band, if not breaking above it, as another form of confirmation that, you know what, the bulls are actually in control and we're leaving behind this kind of level as support, and you expect the rebound to take place. What else would you pay attention to? The crossover between the red line and the blue line, irrespective of the colors. Remember, you have a short-term moving average and a long-term moving average. In this kind of case, the red line is the short moving average. The blue line is the long moving average. You can distinguish this by yourselves by you seeing which of the two is actually fitting the price action much more closely. The ones that fit the price action much more closely, relatively speaking, to the other one is obviously the short one, and the one that is much more smooth and vague and does not fit price action much more nicely or fit the price action nicely is the long one. So something else I would have liked to see is a crossover between the red line with the blue line. Okay, what we call a bullish crossover. We mentioned this in the past using moving average strategies. Okay, this would have been these are the stuff that I would need to see in order to be sure that the price action, it will go to the upside. Okay, I'm not opening a position. I'm waiting for this kind of stuff to happen. I need to see all these kind of things I just mentioned, the RSI breaking above the 50, the Bollinger Band, the price action flirting with the upper bound of the Bollinger Band, the crossover of the short-term moving average or with the long-term moving average first, and then entering the position, not blindly entering the position because they are close to happening. Okay, after they happen, then you open a position much more confident that you will go in your way. And as we just mentioned in the prior example, let's assume that this perfect scenario took place and the price action is indeed rising to higher ground. This is my entry point, okay, 38.2 or somewhere in there. I'm going to start paying attention. I need to see okay, much larger volume and much bigger green candles, okay, will be super beneficial in my eyes, okay, for me to be enticed to enter this position. Let's assume everything happened long here, and you have targets either here, 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 or here, depending who you are and what your risk tolerance is, okay, and how long you will stick in the trade. Okay, so it also has to do with what kind of type of trader you are. For example, if you're a scalper, if you're a day trader, if you're a swing trader, okay, so it depends on a lot of factors. That's why the whole purpose of the whole series is to help you create this kind of modeling in your heads of assessing the situation, okay, identifying different signals, using different parameters, and start making scenarios, okay. Do not approach trading as being black and white, so up and down. Yes, there is a wide degree of gray area in there, and that's what we could thrive when we use correctly, okay. So we need that kind of gray area, okay. So we pay attention to all this kind of lovely stuff, okay. We make best case scenarios. If it does not go on our way, for example, if you entered here, have a stop loss in place, and you know what, follow that rule of accepting your losses, okay. Small losses are much nicer than dumb, persistent, stubborn holding onto something that could probably may never, okay, turn positive. Okay. What I mean by this is, for example, you entered here long and then it started moving downwards. Don't go into this frame of minding, oh, you know what, it's going to rebound from afterwards. No. If you set in place a stop loss, okay, so as a risk-taking, risk management kind of procedure, you have a stop loss there, you give it some time, you give it some room, maybe down there. If it completely breaks below that, fine, I'm out, I've lost money, carrying on, let's move on. Do not, in a sense, do not avoid placing a stop loss because you don't want to lose money. And at the end of the day, you enter a long position there, it does this, and you hold it indefinitely because you expect it. Oh, you know what? Sometime it's going to move upwards and it's going to rebound and I'm going to start making money. There's no need to do that. Accept your loss. Okay. Close the position at with minimal losses. Okay. And move on to your next target. Okay. Become confident at closing positions with losses, small losses, okay, and moving on to a different kind of instrument rather than just stubbornly holding something that at the end of the day could burn your account, okay. So that is a risk management kind of technique that you need to for your own good develop, okay, at least, okay. That's my humble opinion. It's nice. So, did we leave anything back? No. Okay, moving on to a live session environment. Let's study what? Where is the charts? Okay, I have something in place. Let's move. Okay, so what do we study here? Let's go for A for Apple, okay, or Microsoft. Microsoft is a prime example of what I've just explained in the session of having uncharted territories. Uncharted is moving into uncharted territory. If I'm not mistaken, this is an all-time high. I think so. At least I don't have any past prior action here. Let me see to make sure. Yep, it appears so. Okay, so Microsoft is in all-time high territory where we expect to see some sort of resistance, okay, where we would reasonably expect to see some sort of stalling of price action now that we don't have any past prior price action to help us plot support and resistance levels, okay. So this is an area, this is a time where we can use the Fibonacci extension tool in order to draw, this is key, vague, okay, levels of possible stalling of price action. Okay, so let's do just that. For example, my days, this is a lovely chart. Supernova. Okay, so let's use the Fibonacci. What is this? Oh, no, this one. Fibonacci retracement. Okay, as a first. Okay, this is the prime move. Let's use it firstly like this. Okay. You see, whether it coincides with the price action. Okay, so vaguely looking at this, this is the bottom, this is the top. And that's why I've dragged it onto the right-hand side, because we have other price action here. Okay. So where did we see Microsoft rebounding from while using the Fibonacci retracement tool? Okay. Does it coincide with some key areas? Okay. Let's see. So firstly, an area of importance would have been certainly this, the prior peak. So let's mark this area. Does it coincide with some sort of Fibonacci levels? Nope. Still, that's an area that I will be paying attention to. We use all different stuff together. Okay, so we go by the traditional way of doing things. This is a prior peak. Does it coincide with a key Fibonacci level? Yep, 38.2. And this is where we see this kind of, give me one sec, where we see this double bottom being formed. Okay, we mentioned about chart patterns in the past. You see this double bottom here, we just stay there. Okay, so irrespective of whether you would have used the Fibonacci retracement tool, going firstly using support and resistance levels, and I have to paint them green now. Give me one sec. Kind of obsessed with this kind of stuff. Marking support level with green, that was a past resistance level. Now it's support because obviously broke apart above it. So this is an area, okay, that I would have highlighted beforehand, even if I didn't use the Fibonacci retracement tool, as a key area, okay? And remember, we use resistance and support levels as areas, not lines, okay? So this is a much nicer representation of how it should be when using correctly on your charts. So this is a key area that I would have been paying close attention to, irrespective of the Fibonacci, but still plotting the Fibonacci from the bottom to the top, you get that the 38.2 level coincides with this kind of area where we saw the rebound taking from. Remember, this was not a sharp pull down, okay? Let's do the trend line as well. Maybe from here. No, I'm going to use this from here because obviously it fits my bias, okay? So whether you're going to use that trend line or not, it is clear as day what is the direction of the market. And let's discuss what it is. High, higher low, higher high, yep. Higher low, higher high, higher low, etc., etc., etc. Okay? Definitely upward moving Microsoft, okay? Moves in an upwards trajectory, clear as day. Now, we see this kind of breakdown of the price action below this vague and not that nicely placed or nicely fitted trend line, okay? This is an area, pay attention to. Breakdown below it. Now, at this point in time, where is that lovely tool where you go backwards? Let's stay here, okay? So nothing else happened, okay? Assume this. Let's see, do this, okay? So you see the price action moving to high ground, you see the trend line, and you see the price action attempting to break below the ascending trend line. Gives me an indication that, you know what, this is a start of a pullback. And you see here, now you draw the Fibonacci retracement to see where the price action may find support next. I've already placed here a support level, okay? Another one would have been here, okay? Which again coincides with what? The 50 level, and somewhere in there, which coincides with the 61, okay? We do not know where the pullback is going to lead us towards to, okay? So that's why we use all these kind of levels to be marked, and that's why we use a Fibonacci retracement to see how far the pullback will be, and therefore from there I pay significant attention to. And let's play the tape. You see price action, okay? Let me fast forward it. No, it's okay. Okay, definitively breaking below the level, breached the 23.6 level. Where it's going to head towards to next. Okay, find some sort of support. The 38.2 rebounds. Okay, that's nice. Okay, what's next? You see failing to break above the 23.6, stalling there. Okay, moving upwards, but then what's going on? What's going to happen? Sharp drop below the 23.6 and move again rapidly towards the same level I have highlighted. Is it going to rebound here from, or is it going to continue moving south? This point in time, you see rebound, okay? And then a nice, let me pause it right there. This is what I really like while using this kind of tool, okay? This is a very, very nice indication. Okay, this lovely big full candle with a full body. Okay, this is my indication that, you know what, bounced once, bounced twice, and then I see a follow-up of a big green candle. Okay. Oh, sorry guys, give me one sec. Yep, I see an indication of a green candle. You know what? Maybe the bulls are super eager to push the price action to higher ground. Maybe I'm going to be start paying attention to this kind of level. Okay, you see the break up above the break above the 23.6. I want to see a definitive break and then enter a position. Okay, so playing on the tape, you see stalling some sort of consolidating near this level. Okay, but then does some erratic stuff. Possibly this would have been an earnings release. Let's confirm it. Let me pause. Yep, down here. Better than expected earnings report on the both fronts, on both EPS and revenue. Okay, upward surprise. Definitely good news for Microsoft, even though it did not take place at the same day. Okay, for some reason we have a negative reaction. Maybe big boys have started cashing out after this lovely report. Okay, that's why you see this kind of sharp drop, but then a really nice rebound. Okay, so an area where you would have actually paid attention to would have been somewhere in there, or the complete break above this kind of level, which served as an all-time high. Okay, this is certainly something else that you would have paid significant attention towards to. Okay, so you get the confirmation after this big candle. You see some sort of volatility taking place. Great earnings. If you would have went over the earnings report and the outlook for the next quarter, you would have seen that they are super optimistic about what's going to happen. This is certainly good news when it comes to Microsoft, and you would have reasonably expected after this kind of turmoil here that the price action would have risen there, and this would have been perceived as good news in the eyes of the market, piling in buy orders and pushing the price action to higher ground. Once you saw the complete breakout, okay, with some good fashion, break above the prior, okay, key resistance level, okay, which was the prior high. From there on, it kept surging to a higher ground, okay? So the next area of resistance is this, which is the new high, okay? Okay, that was not the last high, sorry. This was the last high. That was the prior past peak. Still important nonetheless. From there onwards, you see, okay, no stalling whatsoever, okay? Break above and then continue to move north of that, okay? So assuming this is the, okay, the tape is done. Assuming now, okay, that you saw this lovely earnings report and all your other indications, if you pay attention, if you have paid attention to the whole thing, okay, that this is certainly a nice area to buy. You got the confirmation, and we're going to see the influx of different indicators pointing that you're going to move to high ground. Okay, the price action moving to high ground. This area, you see, short-term moving average crossing above the long-term moving average. Okay, yellow line breaks above the black line. Certainly a shift in direction, okay, or the extension of the direction in this kind of case. Okay, price action moves to high ground after that. What about the upper bound of the Bollinger Band? It was violated, excuse my words, violated 1, 2, 3, 4, 5, 6 times. Okay, super bullish sentiment on this. Okay, super bullish bias is certainly granted with this. Let's just put it like this. RSI, what is the RSI telling me? Consolidated twice, rebounded, twice from the 50 cut-off point. Certainly important. Okay, bounced once, surged, came back, bounced twice. Okay, you form a formation of a double bottom. Okay, at the threshold 50 key level, and the price action moving to high ground definitely supports a bullish bias in regards to Microsoft. Okay, then you see it breaching the 70 level, and when you see the price action currently stalling, comes below the upper band, moves away from the upper bound of the Bollinger Band as well. So a slowdown, okay, of the pace has taken place here. Okay, so assuming that you've entered a long position after the whole fiasco there, for example, after everything was green, okay, exit point would have been, I like to use this kind of level. Again, this is my own biased opinion. The prior crossover between the two moving averages. That's my style of doing it. You can use definitely something else. Now, assume that the whole thing, we are in a long position in there, okay? Where after this complete break above, of this kind of level, which was a resistance level, which has now turned into support, where would be my next target of exit if I have this kind of level as my entry point? Making a scenario here, okay? How much time do we have? Okay, we're gonna have to wrap it up pretty shortly. Okay, so let's use the Fibonacci extension tool to identify a few key levels of where we be placing significant attention to, because we want to exit the position. Okay, so where is the Fibonacci trend extension? Let me see if I plot this correctly. No. Where is this? Yep. Bottom to the aforementioned top. Okay. And you draw like this. Where is the next area? Hopefully the colors are not confusing you. Let me zoom a little bit more into the price action, or at least make this a little bit more vague or opaque. Okay, so bear no resemblance on the target. You'll see what I mean soon. Okay, so you take it from the bottom of the price action, okay, where the new wave has initiated, if you would like, to the prior top, assuming that this did not happen yet, okay, and you draw it back down towards the beginning of it, okay, much like we have done in the example in the series, okay, in the webinar, in the slides. Excuse me. Where are the key levels? If this is the start and this is the finish, where could we reasonably expect to see the price action moving towards to, now that we have uncharted territory in front of us? And you have seen here with your own eyes that using the Fibonacci extension tool, the actual technical indicator, the tool gives you these kind of levels, these key levels, okay, as potential areas or where you see the price action stalling at, okay? First one is the 127.2. See the price action, okay? Forming some sort of, you see that lovely doji candle up there. This is a signal, possible signal for reversal. That was not the case. We do not have a morning star pattern, okay? So bullish bias is also maintained, because that's another thing we have to keep in the back of our minds, okay? So areas of exit would have been, for example, if you have that much confidence or that much patience, that would have been the 161.8, the key one, in a sense, okay, as target. The other one would have been 127.2. It has broken above it, but still, okay, has fallen back to it. We'll see whether it consolidates near here or it comes and does this. So certainly an area you should pay attention to, because you also have RSI of 70, and it gives you an indication that could move to lower ground. Okay, but the scenario is certainly bullish for the time being. Another target, since we are in non-charted territory, is a 141.4, near there, but you don't actually touch it. Okay, still you use these levels with a grain of salt. We're using areas. Okay, we're not using which one is it? The 385.42 specifically as an area of exit. Your exit position could have been, for example, you have $380. $380 is somewhere in there, okay, in this region, or the 385 round numbers, okay? So this is certainly an area where you pay significant attention now, okay, in regards to the progression of Microsoft, because I'm getting, okay, as we look at the whole thing, I'm getting different indications for the time being. You see a divergence between all these kind of technical other indicators. And let me explain what I mean by this. Now, looking at moving averages, certainly are growing apart. The two lines are growing apart, gives you an indication. The bullish is in favor of the bulls. Pretty self-explanatory. You see the price action, but it gives you confirmation that still the rally has a lot of momentum behind it. Okay, what else? Bollinger Bands. Okay, you see the price action moving away from Bollinger Bands. Okay, hopefully you can see there's a lot of colors there. Hopefully I'm not confusing you. Let's take it out of the picture. Okay, you see the blue line of the Bollinger Bands. Okay, it has been closely moving near it. Okay, but now it starts to form some sort of a top, and you see the flattening of the upper band of the Bollinger Band. Maybe we have reached the top. Okay, and this is something you have to remember, keep them in the back of your head. You know what? Flattening of the upper band of the Bollinger Band. I'm going to be paying attention to this kind of level, because I want to exit the position with the maximum amount of money, or the maximum amount of profit of percentage gains. Okay. And I don't want to wait for the whole thing to unfold sharply. Hopefully not. Okay. Before my eyes, and I leave a lot of money on the table. Okay, so we may be getting here an itchy trigger finger, and you start placing cover positions, closing your positions, going short in a sense. Okay, so what else? RSI. Okay, so you have the RSI moving from the 50 after the 2. Okay, of the formation of the double bottom. You see it rising to high ground, breaking above the 70. And what did we say about RSI breaking above 70? Again, 70 is an arbitrary kind of level, but still gives you an indication that the current market conditions surrounding Microsoft are overbought. Okay, there is too much bulls eager to push the price action to high ground, and they're buying this share indiscriminately. Okay, they want to push price action to high ground, and we have reached an area, okay, a level where that might trigger the bears to come into the picture and cause a correction. Okay, because the bulls have gotten ahead of themselves. Okay, that is one way. That is a way of interpreting the RSI. So it peaked above the 70. It got what, maximum 76 point something value, and then pulled back below the 70. Notice, however, that is still consolidating near the 70. It has not rapidly moved downwards. It's not sloping severely downwards, okay? Which is another indication that this may be just a brief pause of the price action, rather than a signal of a top formation and the expectation that the price action is going to move to lower ground. Okay, that is going to be unfolding in front of our very eyes. That's why we pay close attention to this, because we need to, okay, in order to assess where is going to be the next viable area or level where I'm going to be placing my cover position and exiting, in a sense. Okay, so let me bring back the scenario we just made. Certainly here currently is an area where I'm going to be paying significant attention to see whether I'm going to exit or not. I'm going to give a slight chance, okay, for the 127.2 in the next, this is a daily chart, in the next 1, 2, 3 sessions to see, you know what, is it going to hold there? If it's going to hold there, I hold on to my bullish kind of bias. Is it going to move to higher ground? Obviously, you're going to hold on to your bullish bias there. But if I start seeing big volume coming in, big bearish volume coming in, the bears seeing this as a top, okay, seeing this as a peak, and they see, oh, you know what, this is an ideal end point for me to start shorting this, and I see big red candles and they break down below the 127.2 level, I'm going to be paying significant attention, and possibly I will be exiting my position in order to safeguard the majority of my profits. Okay, so this is best case scenario. You can go a lot of different ways. Okay, and you understand that the situation is very much fluid and it's not fixed. Okay, you know what, it went to 127 and broke above it, I'm going to close the position. No, you assess the situation as days go by, but still have in mind specific target. The ideal exit point, okay, without taking consideration any other thing, would have been the 61.8. This is my ideal exit position, and this is where we draw the take profit line. But okay, if and only if I see the price action not living up to my expectations and validating my concerns that, you know what, if it breaks below this, okay, I see the formation of a top, I will not hesitate to shift, not the resistance, shift my take profit target and bring it down there, okay, to safeguard the majority of my profits. Okay, if the price action does just that, okay, dips, okay, and hits my take profit, okay, and I'm out of the position, good, I've made money. If from there onwards, let me go do the ghost feed. Where is the ghost feed? If it does this, for example, okay, and I exit my position and you see the price action consolidating there and then rebounding, now that I have banked, let's just say, I have exited the position somewhere in there, okay, at this kind of level, I've exited my position here. Okay, good, I've made money. Afterwards, you see the price action consolidating above this kind of level, my exit level, okay, and you see the price action starting to point towards the upside, meaning that, you know what, the bears are not, they have entered the picture, but they're not in control. The bulls will take the initiative and push the price action to higher ground, okay, and I see my RSI, I see my moving average convergence divergence, I see the two moving average lines, I see the Bollinger Bands starting again to give me indication that, you know what, the extension of the move towards the upside is maybe at bay. I'm gonna once again enter, okay, long once again, and possibly have the same target as an exit position and my stop loss down there. Okay, so you enter the position, you exit the position, you have money, you reallocate if it continues to go on your first initial assessment, if it fulfills your first, if it meets your conditions for a bullish buy. That's another way of going at it. If it doesn't do that, if it doesn't move upwards and continues to go south, good, I've exited my position with the maximum amount of money in the bank. what's to hate about this? This is a lovely trade, okay? Going from, where is that forecast? Going from here till there is what? Okay, nearly 10%, okay? Rather than just holding on to the position and banking out, for example, like with a 5%. Okay, why do that? You can do this, okay, if indeed it peaks and moves to the lower ground. And then if it consolidates, the scenario we just mentioned, consolidates here and then starts to move upwards, enter a long position and hope to capitalize upon a what, 2-3%. It's not going to be much if we enter there, but still. It's a 5% trade, okay, with a risk reward ratio of nearly 2 to 1. Okay, you make 2 trades and you can bank anyway. Okay, so giving you different ways of approaching this. Okay, it's not black and white. I just mentioned this a million times once again. Use everything together, but still, let's we passed our time. Okay, let's do a small recap. Fibonacci retracements, Fibonacci extensions in this particular scenario. This is why we use, this is how we use the Fibonacci extension tool. We have, again, this is my own personal bias. You have an instrument that is trending into uncharted territory. You know, you don't have any idea where it's gonna, where you're gonna set your exit position. Okay, where you're gonna set your target. Use the Fibonacci extension to be plotted on your chart to see the Fibonacci key levels, okay, where you see the price action may stall into the near future, and use them respectively as profit targets. That's how you use the Fibonacci extension tool. Super simple. Hopefully, it's easily comprehensible. If not, please let me know in the chat. Okay. Again, you can use all of this together. We use Fibonacci. Remember, we use Fibonacci extensions. We use Fibonacci retrace. Basically, we use Fibonacci. Let's start from the beginning. We used support and resistance levels to see where past prior action has stalled. This is step 1. We identified the move with a trend line. Step 2, we have plotted different kind of indicators onto our charts. We have moving averages, we have RSI, and on top of that, we have used the Fibonacci retracement to see where the pullback is gonna find bottom, okay, where it's gonna end the retracement, where the retracement is gonna end. We identified and we have entered the position using this kind of tool and all the other stuff together with the correct indication of all this plethora of technical indicators. We entered a long position. We used, at the end of the day, the Fibonacci extension tool to set a target. And from there on, we did a day-to-day or a case-by-case kind of scenarios of how it might play into the future and how you adjust your risk management kind of approach towards this kind of trade. So we've done a lot of things together. This was a holistic kind of point of view. Hopefully, it was of help. Okay, so again, we have to wrap it up, guys. Way past our time. Again, if you have questions, please send them through. If not, have a lovely weekend, and we'll catch you on to next Friday for another episode of our series. Okay, and we're gonna do, if I'm not mistaken, risk management techniques. We're gonna do pretty much the same thing we've done here, but we're gonna add a little bit more. We're gonna provide some sort of different insights on how to psychologically go at trading. Okay, how to use psychology. Not how to use psychology. In a sense, we're going to introduce some sort of concepts of tricks or tools that you can use in your own trading that are bypassing some sort of psychological impediments that you may have while trading. For example, being super stressed and not know where to exit a position or all the kind of stuff. Okay, so enough about me rambling. Take care, guys. Hopefully, we're going to see you next week. Okay, have a lovely weekend. Take care. Bye-bye. See you.